Hello, YouTube. Today we're going to be talking about the 50-day moving average and whether or not it is going to be support or resistance because we crash landed, as the bears are going to comment, I'm sure. Oh my God, Justin, you said we were going to go up. I would note that I was looking for a back test roughly 380.5 this week. The fact we are only able to get down to the 50 DMA and now we are bouncing up makes me a little bit bullish. So the big question is this 50 DMA for S&P going to be support or resistance? And on the same token, is that going to be support or resistance for QQQ? Because we came all the way back down, almost tested it, and then bounced up slightly. So on SPY, we actually did close at 391.12, which would have been 1 cent above the 50 DMA. But with the market on close, they pushed it down to 390.89. And after hours, as of right now, we are here at about 392. And QQQ also bounced up. However, there were misses for both these companies. So who reported today? Alphabet, Microsoft, Visa, Chipotle. So Visa, Chipotle did well. Again, I'm recording this almost immediately after the market closes. Alphabet and Microsoft ended up not being so hot. So Microsoft misses on top and bottom line. So again, they missed on revenue and on income. They both fell short. But the stock is not really reacting all that negative. And I think the reason why is because we already had a lot of this negativity already baked in. When we look here at Microsoft, it is down to, right, it was down $6 on the day or roughly 2.7%. And we're down about another 1% in after hours here. So what's interesting to me about Microsoft is just that the pattern is still here. We're still rejecting off our downtrend. We have a head and shoulders. We lost our key pivot and we're having a really hard time reclaiming it. But what's really interesting here is that bad news is having a muted effect, which means we're down by less than 1% with a miss on the top and bottom line. What does that tell you? Well, it tells me that this is likely largely priced in, again, barring that we don't get a huge move overnight and that these levels roughly hold. Missing on top and bottom is usually not all that great. They're not huge misses, but they're talking here about exchange rates. So the dollar is still playing a role. If we now shift gears here to Alphabet, Alphabet, I believe, missed on, earnings and revenue. They missed as well. So it looks like they missed on both as well. They missed on earnings and on revenue, and stock is actually doing okay. And I think the reason why is because Google did well on the cloud. So we can note here that Google is up by 3.3%, 3.2 right now. It is back to green on the week, but the pattern is very similar where we're pointing down, and that is still the path of least resistance. So what's so interesting is just that after we have all these earnings, again, we've had, beginning of the week, we've had the pre-market, now we have after hours on Tuesday. Shopify already guided down, so did Walmart. I think it really comes down to whether Apple or Amazon are going to deliver, but as of right now, those are the last two. Microsoft is the second largest company in the entire stock market, so it seems to be doing okay, and I think that we have to just kind of watch for what the tape is telling us. In terms of what the broader market could do, again, what I'm looking at here is that, yes, we are red on the week. We are red by 1%. And we can note that how much is the dollar up by this week? Oh, the dollar's up by about 0.6. So S&P should only be down by about 0.3% or about $1. And what are we up in after hours? About $1, which means, again, we're having a really hard time finding direction. The dollar is the culprit, and earnings are not really having that big of an effect. Why would that happen? Why are earnings not really impacting us anymore? Well, maybe we're at peak fear. And why would we be at peak fear? We're inside of fear. And in terms of capitulation, we already know everyone's capitulated, including money managers. So if money managers are capitulated, and this is from the B of A, we talked about this on the weekend deep dive. It's from July 19th. And they're telling us that they have the lowest risk exposure going all the way back to the great financial crisis. So what does that mean? They have less money in the market today than they did in 2008. If you think that this might be not as bad as 2008, might be a good time to add some risk on. Why? Again, capitulation with a lot of fear, and negative news is not really impacting in a negative way. I would have expected us to actually get down below 390 today. And why would I have expected that? The reason why is because at what point are these bears going to take control of the chart? If we look here, so now we want to try to understand what's happening. So there's been accumulation happening. The red days have very weak volume. So looking at the last 3 days, Monday's the most, that is Friday. Friday's the most elevated. Today is soft. And we're back up in after hours. So I don't know. I really want to watch what happens on a pivot here at the 50 DMA. And the reason why that's important to me is just because as we look over here to our gap, what's that area? That area right there is 389.75. What's our low of the day? Our low of the day is 389.95. That's 20 cents higher. So what does that mean? We defended the gap after getting inside the other one. And now we're back up in after hours. We're back above the 50 DMA. Yes, I understand that the narrative from retail is fear. It is recession. It is bearish. I understand that. We're still in a bear market. It's hard to argue with that. However, when we watch what the stocks are doing in reaction to what we would expect, again, read these two headlines from Google and from Alphabet and tell me what you would expect to see happen. Apple misses on top and bottom line. Let's see if they refresh this title here on Google. Right, Google misses on earnings and revenue for second quarter. So Microsoft missed on top and bottom. Google missed on earnings and on revenue for second quarter, which means back to back. What's the reaction? Google up, right? Google's up. It's up still 2.5%. Is it going to hold? I don't know, right? I'm not that smart. I don't know if it's going to hold. Google down by 1.4. So between both, which both missed, the market's up. QQQ is up, back up over the 50. S&P is up. So again, I would highly encourage people to keep their comments to themselves and watch the tape. The tape is telling you what's happening. Whether or not you agree with it is a completely different story. So with these two headlines of double miss for the second time and miss on top and bottom, CNBC is choosing these headlines on purpose, right? They want that to be a little bit fearful. And we look at the market, where are the bears motivated? Absolutely. They were motivated like you wouldn't believe yesterday. And what about today? Okay, cool. So going to the 27th, what do we got? We got fat stacks of puts. Huge, right? So from 393 down to 390. Open interest. We got all the way down to 385, 386. And they just can't seem to take us down. On the call side, we got 392. Sorry, really 392, 393 to 395. And it shows that the bears are still buying more puts than calls are being bought by the bulls. So what does that mean? Well, they're motivated. They got us below the 50 DMA, but they couldn't hold us below. That is not what I would expect with a double miss. I would expect that we would be big time down. I'm talking like 385 or something like that. These are two of the biggest companies in the world. They have some of the biggest impact on the market. Same put motivation here for the bears going to July 29th, which will be Friday. And this right here really seems like the target, 385 with roughly $2 in premium. So we need to be down at about 383 for them to get their money back. I can also tell you that as we reviewed yesterday, there are puts that go down to roughly 360. On the call side, it's still 395 and still 390. So what is max pain? 390 on Friday would be max pain. That's roughly where we are right now. So if that's max pain and we now understand that we're coming out of a base of fear, and stocks generally bottom on fear. Also, what are the stocks doing in reaction to what we would expect? Well, I would have expected us to go down. We did not. We back tested the 50 DMA on SPY and QQQ and bounced. So for me, that's bullish. What do we have going for the rest of the week here? Well, Meta, again, expecting probably a dumpster fire on that one. We have a whisper beat, but I'm not sure. I don't think Meta is going to have as big of an impact because we've already heard from Snap to take a lot of the wind out of the sails. We had Alphabet miss again, so those are pretty much the advertisers. So I don't think that if Meta misses, it's going to be like, oh my God, it's such a surprise. Apple and Amazon, I'm really not sure. Shopify and Walmart both getting down yesterday and then this morning kind of tells me that retail is having some issues. Is Amazon special? I don't know. I think a lot of people might have waited for Prime Day, which fell in July, or not in calendar Q2, so that could have an impact. Other than that, Visa's up, MasterCard's going to report. We're almost through earnings for the week, right? We're through the most important part. We got Thursday after hours. Otherwise, I think earnings has been shaking out really bullish. We also climbed the wall of worry by getting through the 2-year note auction yesterday, consumer confidence today, new home sales. Both were negative. And what happened? Well, we went down, but not as much as we would have thought. So we note here that, new home sales fell. It's a miss. Consumer confidence fell. It's at 95. So, wow, that's like kind of really important. Yeah, negative news is like taking us down to strong support and then we bounce. That's bullish one more time. So two more things I want to point out here is just that tomorrow is going to be very, very, very important. Red is going to be the most important data point with the FOMC rate decision and press conference happening at 2, and then the press conference happening at 2:30. And the reason why, again, not that I know, I'm not Nostradamus, I can't predict the future, but when I look at what I would expect to see happening, I got this the screenshot from yesterday. This is the Fed's inflation battle. It's core PCE. So what is core PCE? So let's have a look at the definition here to make sure that we're not leading you to ruin. So let's have a look at this here. Oh, I was wondering what that was. I thought it was blotched on my screen. Anyways, what is core PCE? Core PCE is the index defined as personal consumption expenditures, PCE, excluding food and energy. So the Fed does not care about food or energy. What's causing the inflation? Food and energy. So what does that mean? Their definition of inflation is the core PCE. And what is it at right now? Their projections, are they correct? I don't know. But 4.2 for this year, 2.7 for 2023, 2.3 for 2024. What has Jerome said? We are dead set on getting inflation back down to 2%. And again, these numbers are not really all that bad. There is a warning sign I will point out in 1 minute, but look at these numbers. Look at where the 10 and 2-year note are right now. We can note that the 2-year note is at 3%, the 10-year note is at 2.8. Does that make sense as we look at this diagram here? For me, absolutely it does. I understand. We're going to have shorter term inflation for the next couple of years, but over the long term, or roughly the next 10, we're back down to roughly 2.8%. So what Jerome has to say tomorrow is going to be very important. The other reason why I think that we might get a bullish reaction regardless of what happens, 7,500, I don't know. Look at the dot plot here. The median projection is ticking down. Why? Core PCE is expected to go down. Are they correct? I don't know. But we have to listen to what the Fed says. Do not fight these guys. They move the market. They control the liquidity. So we have a lot more data to get through by Friday. And the one thing that does concern me going into tomorrow or Fed Day is going to be this. It's going to be the 2 and 10-year inversion. We're now at a record we have never seen, a new all-time high on the 2-10s inversion. 1.088 is the previous all-time high going back to August of 2000, and we just breached it. We had a high of 1.1, which means that the 2-year note got as much as about 10% more expensive than the 10-year note. Is this a prelude for something to come? I don't know. But I also note that the dollar is starting to rocket back up, back above that 106.56 area that we are watching going back to 1989 or the arrow here. So the dollar is flexing. The dollar is adding pressure to equities. And that's because there's turmoil happening in Europe. So what's going to happen? I'm not sure. But as of right now, what I would have expected to see is, hey, as long as we are above 380.5 or what? A back test of our falling wedge and our key relative low, that is an inverse head and shoulders or a back test of our downtrend. For me, that's bullish. We're 10 points higher. So as of right now, I am seeing evidence that tells me that I should remain on team bull because that is the team for risk reward. The probability is still we're going to go down, which means it's most likely we're going to fade. But for me, I want to make money. I don't care about being right. In the comment section, I would love to know what you think. Do you want to be right or do you want to make money? Thank you for watching, and I look forward to seeing you tomorrow.